You own three different funds, an S&P 500 fund, a Nasdaq 100 fund, and a technology fund, hundreds of companies. It feels diversified, but over 44% of that Nasdaq fund is sitting in the exact same handful of giants as your S&P fund. You do not own three bets. You own one bet three times, and you are paying three fees for it. Here is how to check yours in 2 minutes. Before we begin, the disclaimer. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell anything. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them. Today, why owning three different funds can leave you holding the exact same bet and how to check it in 2 minutes. You did everything right. You didn't bet on one stock. You bought an S&P 500 fund, a Nasdaq 100 fund, and a technology fund. Three funds, hundreds of companies feels diversified. Except under the hood, all three are leaning on the same handful of giant companies. You don't own three bets. You own one bet three times, and you're paying three fees for the privilege. This is the overlap trap, and studies suggest the majority of self-built portfolios have it. To see why, you have to understand how most index funds are weighted. The majority are market cap weighted. That means the bigger the company, the bigger its slice of the fund. In a 500 company fund, the largest company might get $5 of every 1,000 you invest, while the smallest gets 10 cents. So a so-called diversified fund of 500 names can still have a huge chunk of its weight sitting in just the top handful. The long tail of small holdings barely moves the needle. Now, here is the problem. The same mega cap names sit at the top of almost every popular fund. The biggest technology companies are the largest holdings in the S&P 500, the largest in the Nasdaq 100, and the largest in any technology sector fund. So when you stack those three funds together, you are not adding new exposure. You are piling more and more weight onto the very same companies you already owned. Let us put real numbers on it. The handful of companies that overlap between a standard S&P 500 fund and a Nasdaq 100 fund make up over 28% of the S&P fund and over 44% of the Nasdaq fund, the same names. And a Nasdaq 100 fund and a technology sector fund can share 7 of their top 10 holdings outright. You think you are spreading risk. You are concentrating it. The reason this is so easy to miss is that each fund looks diversified on its own. The S&P fund holds 500 names. The tech fund holds hundreds. Nobody reads to the bottom of a holdings list. But diversification is not about how many lines are in the fund. It is about how much of your money actually depends on a few outcomes. And once you stack overlapping funds, a huge share of your money can ride on the fortunes of 4 or 5 companies. So why does this actually hurt you? 3 reasons. 1, amplified risk. When those few mega caps stumble, your whole portfolio drops together because every fund you own is pointing the same way. 2, fake diversification. You believe you are protected by spreading out, so you may take on more total exposure than you realize. And 3, redundant fees. You are paying 2 or 3 separate expense ratios to own what is largely the same basket. And this is measurable, not just theory. In one analysis, 2 heavily overlapping tech funds had a combined overlap of 55%. When that overlap was cut to 25% by choosing less redundant funds, the portfolio's volatility dropped from 18% to 15%. Expected return only slipped slightly from 14% to 13%. You gave up a sliver of return and removed a meaningful chunk of risk. That is the trade overlap is silently making for you in the wrong direction. Here is the good news. You can check your own overlap in about 2 minutes for free. There are ETF overlap checker tools online where you paste in two or more tickers and it shows you the shared holdings and the combined weight. But you do not even need a tool for a first pass. Just open the top 10 holdings of each fund you own and lay them side by side. If the same five names dominate all of them, you have found your answer. If you find heavy overlap, you have a few honest options. You could simplify down to a single broad fund instead of three that duplicate it. You could deliberately add genuinely different exposure, things the mega caps do not dominate, like smaller companies, international markets, or other sectors entirely. Or you could use an equal weight version of an index where the giant companies get the same small slice as everyone else. The goal is not zero overlap. It is knowing your real combined exposure and choosing it on purpose. Now, to be fair, overlap is not automatically a disaster. If those mega cap technology companies keep winning, a concentrated overlapping portfolio will outperform a truly spread out one. Concentration cuts both ways. The danger is not concentration itself. The danger is concentration you did not choose and do not realize you have. There is a world of difference between deliberately betting big on technology and accidentally doing it while believing you are diversified. To wrap up, most index funds are cap weighted, so the same few giants sit at the top of nearly all of them. Stacking an S&P fund, a Nasdaq fund, and a tech fund does not spread your risk. It concentrates it while charging you extra fees. Check your real overlap. Know your true exposure to your top few companies and decide your concentration deliberately instead of by accident. None of this is a recommendation about any specific fund. That is for you to research. If this opened your eyes to what is really inside your portfolio, consider subscribing and, as always, protect your downside first. Thanks for watching. And if this made you want to go look at what is actually inside your funds, do me one small favor. Tap like, it genuinely helps more investors find this. Share it with the friend who owns five funds and thinks they are diversified. And subscribe so we can keep going deep together. Every week we do the digging so you do not have to guess. See you in the next one.